Hello, everyone. Thank you for joining Professor Siegel live on Trump's tariffs impact. Today, you will hear from Jeremy Siegel, Wisdom Tree Senior Economist, Jeremy Schwartz, Global Chief Investment Officer, and Sam Rines, Macro Strategist Model Portfolios.
Professor, as you're getting through the tariffs, through the earnings reports, how are you looking at all these news events? We'll come back with some questions here.
Yeah, absolutely. I've got a couple slides just to show you. Then I'm going to explain my interest rate. A lot of people were puzzled they thought I was now a Trump supporter when I supported Trump's call to lower interest rates. I'm going to talk a little bit about that. Just because Trump is completely wrong on tariffs doesn't mean he's completely wrong on everything. And then I'm going to talk a little bit about the earnings. Let me see if I can get some share on, which I think might be of interest to our viewers. This first one over here, now we're not in a bear market. We came extremely close, but I took every bear market since 1986. And I asked the question, what happens if you invest at the beginning of a bear market? Now, some bear markets is 20%, get much worse. And I looked at 1, 3, 5, 10, 20, and 30-year returns going forward. And these are the second to last row here. And the average is always better than the buy and the hold. So, again, we're not in a bear market quite yet. But if someone invests at the beginning of a bear market and for 1, 3, 5, 10, 20, and 30 years, on average, you will be better than buy and hold. And buy and hold, as we know, is damn good. So, this might be comforting to some of your people who wonder about, could it get worse? Yeah, it can get worse. We could get a major bear market. I don't think we're going to get there because I think Trump is going to relent. But the longer term holds, and even the shorter term holds, on average, have been really good. I want to also show you this. This was actually really interesting. I've seen it before, but Torsten Slok of Apollo passed this on earlier this week, and it shows the percent of U.S. manufacturing in percent of U.S. total and non-total employment that has been in manufacturing. And over the last 80 years. And as you can see, it was 40%. And this, of course, was war. Then the war came down. And it was steadily decreasing. No, international trade, no China. There was zero trade with China, Russia, Europe. It was still steadily declining, big declines. Here's NAFTA. To blame the decline in manufacturing in NAFTA when already 75% of decline. By the way, NAFTA did not accelerate anything from the trend at all. Here's when China joined the WTO, and we did get a drop there. By the way, we got a drop in every recession. And there was a recession that came in 2001, as we know, the tech bust. And it dropped. And then it kept on dropping, dropped in the financial crisis. This is where USMCA, this is where Trump actually renegotiated the NAFTA agreement. As you can see, it's been pretty flat, but actually slightly going down here. Now, so, almost all of it, there's no real crisis that suddenly developed. This has been a long-term trend. If you take a look, I'm working on it on Germany, Britain, and France. I got data on that. They all declined also. The country that declined the least in manufacturing is Germany, and Germany is in the worst shape now of any major country. There's a book out called Kaput, which shows that the German reliance on manufacturing and trying to keep it along has totally hollowed out the economy. Many of its manufacturing companies, including its car manufacturing companies, are facing bankruptcy as a result of not moving into tech and other service areas now. So, I just thought that would be of interest to you. I also want to show you, one more here. I mentioned on Monday, the big question about Powell is the tariff going to affect long-term expectations? And we have an instrument that the Fed itself has used for over 20 years. It's called the five-year forward. It's based on inflation swaps. You can back out what the inflation rate is expected to be 5 years from now into the future. And that's exactly what I've plotted here. It's called the 5-year forward CPI inflation. And you can see it's actually gone down. The latest data is 2.3. This is CPI, and as I pointed out, CPI is about 30 basis points over PCE, which is the goal of the Fed. So basically, long-term inflation expectations are exactly at the Fed level, long-term target. There's been, at this point, by sophisticated investors, in fact, this is the lowest it's been, except for a spike down here, in 4 years. So the concern about it going into inflationary expectations in the long run is just not there, not in the data. In the short run, there's no question that if these tariffs go into effect, it's going to affect the short run. But the question is the long run. And the data is that it's not affecting the long run. In addition, as I mentioned, that the money supply growth. I mean, here's the money supply growth. The tremendous boom that we had from 2020 to 2022, the fastest money supply growth in history over a 2-year period. Then the big clampdown that caused almost a recession and a bear market. And then, but the increase since then has been below 4%. And we had 36 years of a period over here, as you can see over here, from 1986 all the way on, which was average 5.5%. So our liquidity is not growing fast enough. The only way to grow the liquidity is lower interest rates. So on the money supply based on forward expectations, and these are analytical measures, there is a very good case for the Fed to lower interest rates. There's also a big political case for the Fed to lower interest rates, because you know that if he is too slow on lowering interest rates, Jay Powell, and we have a recession, Trump is going to blame it on Powell. Now, of course, we don't want him to bend if he doesn't think it's the right thing, but I'd actually think it's the right thing. I mean, we're now in an inverted term structure again. The 10-year now at this instant is 4.27. The Fed funds rate's 4.33. It's a slight inversion. And as I've showed you, I mean, the average spread between the Fed funds rate and the 10-year yield is 120 basis points, depending on whether you exclude recessions or not. So, basically, if you go through history, in 75 years of history, the average, and this is 55 years of history, this is 1950, the Fed funds rate should be at least 100 basis points below the 10-year. And it's now above that rate. So if you want to go to a normal term structure of 100 basis point slope, you get the Fed funds rate down to 3.3%. And that can be justified on the data, can be justified on the money supply, can be justified on the 5-year long-term expectations of inflation. So I'm giving you, really the analytical data over here. Let me stop that share for a moment. As far as earnings, I mean, some of them are good. I mean, listen, I mean, all these earnings, the middle of the earnings period is the middle of February. February 19th was an all-time high of the stock market. We knew there were going to be some, way before Trump put these tariffs on and started messing with them. So they don't reflect anything of the tariffs. We have at least three types of CEOs that are making projections. One type, I guess United Airlines with Kirby did it early. He reflected expectations of what our earnings will be if there's a recession, when there's not a recession. By the way, the betting markets are over 50% for a recession. Wall Street is between 40 and 50. It all depends, of course, on what happens with tariffs. But and Kirby's estimate for United Airlines, the difference is enormous, of course, of what you're going to get for a year ahead. Then there's a type of CEO that throws his hands up and says, I don't know, so I'm removing guidance. Then there's a type of CEO that says, well, I don't know, so I'm going to keep whatever I had before as if nothing has happened. So, then there's a few CEOs that have actually calculated a tariff rate that they think, and we're going to talk about that, what is the base rate of tariffs, and have tried to incorporate that, and I think that should be the goal of all the CEOs out there. We don't know what's going to happen. The current data reflects almost nothing of the tariffs. The only current data that reflects anything of the tariffs is expectational data, and we all know the University of Michigan and the Conference Board data is extremely bad on that. Although we also know that the linkage is weak. But any current data is not reflecting anything whatsoever on it. In fact, as we know, there's been an acceleration of buying ahead of tariffs that is really only beginning to show up in the data. So, there's no data that shows this. The only data that will show it is when grocery stores and supply stores and the consumer gets reports, oh my goodness, what I bought for $10 is now $12 or $15 or $18 or whatever. And none of that's happening. None of that. Although I think we had Churchill Downs, Kentucky Derby actually said we're stopping construction because we heard that construction costs are going to go up by 20% as a result of the tariffs on Canada and wood and everything, and that is beyond what we think is we want to face right now. I mean, there's been some cancellations there, but most are ignoring it. So none of the data really affects it, and we're not going to get data for a while, I think, that does reflect it. What is the base case? I mean, right now with the market, getting back a lot of it, they think, all the basically, if my estimation is that the market thinks that we're going to get to a 10% tariff and maybe 20% on China, with some exemptions to China beyond that 20%. It's hard to predict because I actually think a 10% tariff and 20 on China is going to have more an effect than I think is right now discounted. But of course, it could be a lot less. Trump does watch public opinion polls. They're not going in the right direction. And by the way, they're not going in the right direction without, consumers hear about higher prices and they're a little worried about it, but they haven't experienced it. So there's a whole group of consumers that say, well, you talk about a lot of things that never happen. So, I'm doing okay now. And by the way, you take a look at jobless claims. I don't know, it seems stuck at 222. It used to be very volatile. I don't understand. There's like zero volatility now on jobless claims, which is kind of amazing there. But it's stuck at the sweet spot. You're not getting it in any of the current data, and you won't get in any of the current data for a while. We're not seeing any layoffs. We're not hardly seeing anything of the layoffs on the federal. I mean, are they not applying for unemployment insurance, or we can get their jobs back, or didn't want those jobs, or took the buy? I don't know. They're just not. They're not coming through at all. What more can I say? I think the Fed should lower. I think the market is beginning to expect them to lower. But it all depends on the unpredictability of tariffs. I think right at this moment, at this level of the stock market, there's a lot of optimism that it just is not going to stay anywhere near what it is now. Any of that optimism that fades gives downside risk to the market. The TIPS is down to 26. Long-term, not TIPS. The VIX, the VIX is down to 26. The long-term VIX is 20. So really, we're slightly elevated at expectation. As the market has rallied, that VIX has gone down from 60 to 26. Actually, I like it better when the VIX is higher because it means there's a lot of hedging in the market and a lot of fear, and that could go away. When the VIX goes down, there's less hedging and fear on that. Sam, do you want to say a few words before we go to questions?
Sure. So I couldn't agree more about the earnings, and there's the different style of management and how they're announcing earnings. The two that I really zeroed in on this week in terms of getting some information on tariffs are GE Aerospace came out with earnings, great backlogs, etc. They feel as though they can completely offset the tariff impact, assuming that the rates today stay in place. That's their assumption. And really had a great slide in the investor presentation on we can shift different manufacturing and we can push a little price to make up for the inflation that we see there. And again, that's a very, very large company, very, very significant backlogs. And margins doing very, very well. So they've got space on that front. And then there's a company like Pool Corp, and that's chemicals for pools, renovations for pools, new pools, etc. Not exactly the best time to be in the pool business when the housing market and interest rates are here, but they're only expecting a 1% inflation impact for their cost structure from tariffs. It's going to be a little difficult for them to pass it on in certain respects, but when it comes to the commodity pricing, they can typically pass that on. So to me, it's pretty interesting. You're beginning to find pockets of the market that are relatively tariff immune, or at least going to have a much smaller impact from tariffs. And those are the places that I think the market should begin to sniff out. Is who's doing a good job of understanding their cost structure in the tariff environment, who's resilient and who isn't. I think that's going to become increasingly important for investors over the next several months in particular.
Yeah, well, and one should comment. I mean, we're talking about tariffs. I mean, what do we import? About 13%, 14% GDP. So 86% is produced in the U.S. Doesn't mean they don't use parts and et cetera. That's the problem. It's the uncertainty of the supply chain. You might produce most of it there, but then you have uncertainty of what you're going to get and how you're going to price it and all that. Plus, we all know the mainstream media is if those avocado prices start going up, you're going to hear that forever on MSN, and you're gonna and they're gonna make a big deal of that, and that is not going to be that's not going to be good press if that happens that way.
Yeah, just wait for Chipotle to raise the price of guacamole, and that'll make the headlines for 2 straight days.
We're getting a lot of questions on what to do. A few types of questions on the dollar, gold, and would make a good hedge to equities if people, based on all the dynamics that we have here. Any comments from?
Let me talk on the dollar, and I was going to talk on that. And so the dollar's gone down 10%. If you take a look at the long-term dollar, and actually, I think I can share that with you. If I can, wasn't planning on doing that because that is really kind of interesting in terms of what it shows. And yeah, here we go. Can you see that?
Yes.
Okay, so this is up to date. So here's the long-term dollar over a 35-year period. I mean, this is how much it come down, and very fast, 10%. But take a look at it compared to, how it's vacillated over the last 35 years. And by the way, it really has, it went up when Trump was elected, and it lost a little bit more than it went up. But, on a long-term basis, It's not something. Now, the problem is that at 10% from this position, which was very high, you're going to pay 10% more on that. So you got tariffs plus that. But don't forget, I mean, it's really not that much different than what on the average of the last 10 years. So I think that's important for you to see in terms of, yes, it's been a very fast decline. But in the big picture of things, this is not, oh my God, the Dow is at, lows. Yes, it's just kind of hitting multi-year lows here, but these are very high figures of the last 35 years. And stop the share on that. It will affect. By the way, okay, let me go one step further. Great for earnings on the S&P that import that produce abroad. But because they're going to be translated into dollars, that's going to be good. They're going to translate into more dollars. So that's a tailwind on earnings. Now, on the backside is we do know there's some boycotts of American goods, so they're going to have some resistance there. But the euros and the dollars, the euros they bring back into dollars are going to be worth more dollars because the euro is worth more. So that's a headwind for earnings. The drop in the dollar, it's a tailwind for earnings. It's a headwind for consumers, a tailwind for earnings. So that their drop is good for producers and suppliers, not good for consumers. In the big picture of things, this is not a crash of the dollar by any major thing. As far as gold, I told you the trend is then make the trend your friend. This is a momentum play, and I don't know how much further it'll go. The only thing on Bitcoin, it actually has finally disconnected a bit from the NASDAQ, although the NASDAQ has shot back too. We see Bitcoin right now at 94,004, and so it's recovered a lot, not to where it was. Actually, it hit 110,000, so it's still 15% down from its high, which is not that much different than the S&P from its high, actually. But over the last couple of weeks, I've been impressed by the fact that its correlation with NASDAQ has definitely gone down, which is good for the asset class, which was not, which was billed as an independent asset class, and now is not as much of an independent. I don't know how much gold will go. You're finding safety on it. And in the meantime, we see the stock market is, jump back, 8-9% on hopes of the dollar. On what it's going to go. So, you're not buying, at anything low. Listen, our basic thesis of diversification is still there. Obviously, holding European, equities and foreign equities when the dollar is down by 10% just automatically raises your dollar holdings in foreign stocks, even if their index doesn't go up 1 penny by 10%. So from February till now, your foreign holdings gone up 10%, in addition to what the foreign holdings have done independently. So that's of course the gain of diversification, which is fundamental to our investment thesis.
There's been a few questions on, and maybe I'll make a comment on the bonds, and we've talked on the call in the last few weeks that the professor is not overly excited about the long-term returns on long bond duration. So there's an element of, with that inverted yield curve, why take a lot of the duration risk for people on the gold side? I think the big challenge has been where do you fund gold from? So we'd encourage people to check out some of our gold plus strategies where you could add gold on top of large cap equities, so you don't have to sell equities to buy gold. I think that's something that's still useful. Sam, there's been a lot of questions on international, and China in particular is a key focus of the tariffs. Lee Chen on our team has talked a little bit about, a few weeks ago, she was more optimistic than the market on coming to a deal. As things have gotten, now people are saying Trump has met China, and are we going to get to a deal? now she's getting a little bit more cautious on just where the market's positioning for the deal dynamics. Any commentary you'd have on just the international deals that you're seeing being discussed now?
Sure. I think it's very, very intriguing, the focus on a China deal. That China, there's going to be a lot of difficulty in getting a China framework set up anytime soon. That's much more of a longer term thing. This is not something that's going to happen in the short term. It is likely that you're going to continue to see a bleed out of positive headlines, particularly on the India front. When Vance was in India, Vice President Vance was in India this week. He said they were getting close to a framework. That makes a lot of sense, given that we were negotiating a free trade agreement with India prior to this tariff kerfuffle. And then you had positive comments on Japan and South Korea as well.
We should also mention about Apple's intention of supplying the entire U.S. market from India by the end of next year.
Yes, and that is an incredible amount.
I mean, whether they can go through it, that is incredible. So they'd avoid, at least on the U.S. market, all the tariffs, or 90% of those tariffs, if they can make that switch. We've been positive on India for quite a while, I think, and we think we have the best India ETF.
And it's really intriguing to me because the knock-on effects of having Apple do that type of investment in the ground is not meaningless. I mean, that is a significant amount of capital. That is a significant amount of hiring. That is a tremendous amount of supporting businesses, entrepreneurship. That's likely to have a similar effect to when Apple or other very, very large innovative companies move that much. It tends to have a very, very good effect on the broader economy.
Professor, somebody wrote in now calling the Mag 7 the Lag 7, that they're now starting to lag the markets. Sort of some of the it's been knocked off their pedestal. Any comments on the rotation that we're seeing?
Well, actually, they've jumped back for last week. We Alphabet gave good earnings, Google gave good. I mean, commentary. We don't see anything yet, and everything. Yeah, you don't see anything yet. I mean, I'm not saying it's going to, that they had good margins. They had a lot of good stuff in the Alphabet report. We all know about Tesla. What more can be said? I mean, if it's only a car company, it's worth 50, and then it's everything else. I don't know about their self car. I mean, there's a lot of doubts about that, and hope on everything else. Again, no one is really feeling it yet. It's just the beta of Mag 7 is 1.45, so the market goes down 10. It's the same thing. When the market goes down 1%, then Nasdaq goes down 1.2. I mean, there's differences, but I mean, this has been true for 20 or 30 years. We have had a bounce back of Mag, but listen, it was really high, and now there's a big question here. So it's a shift down on that. I still think if interest rates do move down, that our dividend strategy stocks will begin to outperform, as I've said for a while. But 4.33% on treasuries, short-term treasuries, is really a competition, because very few good, although there are some, but among all of them, dividend-paying stocks are yielding that high at this point. Once you get down to 3%, that's a different story.
Just to add one quick comment there, I think what the professor is saying here should be like highlighted and with a big star and underlined. That you look at some of the earnings reports this week from the consumer packaged goods companies, Kimberly-Clark, not great, decline. Procter & Gamble, PepsiCo, Coca-Cola, all seeing a little bit of a headwind on the revenue line. One of the first things that they go for when they need to maintain margins is the spending on advertising. and marketing. And that is going to be problematic if this continues for some of the Mag 7, including Alphabet, including Meta, et cetera. So really paying close attention to what those CPG companies are telling you right now could pay some dividends in the future.
So, Professor, thanks again for doing this, and we'll see you again post-Fed Day.
Yeah, have a good weekend, guys.